All right, welcome back. You're watching The Money Show with me, Kavita Thapliyal. And capital gains is defined as any profit that is received through the sale of a capital asset. The profit that is received falls under the income category. But all of this can be very confusing for an ordinary investor. The complication increases further when we talk about capital gains tax on inherited property for insurance. On The Money Show today, we will declutter the jargon involved with Divya Baweja, partner Deloitte India. Divya, good evening. Welcome to the show. We are going to talk about various tax implications and tax angles related to your property, your investments, and your gifting specifically. So let's talk about inherited property. For example, I have a property that was bought maybe in 1950s, okay, and where it's inherited property, it's a pass it on property, and one finally sold it off in say 2022. What's the tax implication that's involved over here? What kind of costing and the holding period, cost of acquisition, maintenance, etc., will be counted in when you talk about the tax treatment on this inherited property?
Yeah. So, hi, good evening. So when we look at any of these inherited property, there are a couple of things that need to be borne in mind. One is that when we look at the cost of acquisition, it is the cost of acquisition to the previous owner, as well as when we look at the holding period, if it is inherited, it is the holding period of the previous owner. Now, if any property which has been purchased, say, as you said before, April 2001, what we really need to do is we need to get the fair market value on 1st April 2001, and that becomes the cost of acquisition. And when I then sell it subsequently, we will be able to index it, and the cost of indexation becomes the index cost will be my cost of acquisition. And whatever are the sale proceeds, from there we reduce the indexed cost of acquisition. If there is any cost expenses on transfer, or if there's any cost of improvement, those get reduced. And the balance is my capital gain, which gets offered to tax.
So, Divya, what exactly is the cost of acquisition that's involved over here? How do you evaluate that? How do you also evaluate cost of improvements in a property that's been inherited and it's basically passed it on since so many years?
So, see, cost of acquisition will be your fair market value on
Right.
1st April 2001, because that is something which is important, because if it is a very old property, then you go by the fair market value. So it is that's what the law says. Now the issue is that how do I really do the fair market value? Should I go by the stamp duty value, or should I take the fair market value? So that is where a question arises, and one may want to take some fair market value quotes from registered valuers and see if it is higher than stamp duty value or not. So, but that is how one will need to really calculate my fair market value. So registered valuer could be one option that one can look at. And then the cost of improvements, all that you spend subsequently after the 1st April 2001, is what becomes the basis for calculating the cost, the total cost.
How will you calculate the indexation benefit? Is there an indexation benefit?
Yeah. So indexation benefit is provided. So the law, the company the department comes out with the cost inflation index. So every year they'll come out with the cost inflation index. So the cost inflation index of the year in which you are selling it, divided by the cost inflation index in the month of April 2001, multiplied by your fair market value, will give you the index cost. And that will, the basic purpose of doing this cost inflation adjustment is to make sure that, my cost, that looking at the inflation factors, what could have been my cost today, and then you reduce it from the sales proceed. That is how you really calculate the index cost.
What exactly are the technicalities and documents involvement that one should be taking care of, because it's
It's an
inherited
old
property?
property,
Yeah,
right? So
exactly.
what would really help is, one is that obviously you will have your property papers which are there. Then there should be a will or an inheritance deed which is there. And if it is gifted, then you need a gift deed. So these are the documents which one should really have it in your records. and any expenditure that you incur subsequently, say on transfer or any expenditure on improvement, those should be those documentation should be maintained so that in case any audit happens by the revenue authorities, you can substantiate with the help of those documents.
Divya, since you're talking about capital gains, and this is something that we discussed on inherited property, but then let's basically understand capital gains on different type of investment instruments and financial assets that we're talking about.
Right.
What exactly is capital gains, and how can one evaluate that?
So, when we look at different assets which are there, the key thing is that what is the holding period which will define whether an asset is a long-term asset or a short-term asset. Because the capital gain is dependent on whether it's a long-term capital gain or a short-term capital gain. For example, if I look at listed securities or equity-oriented mutual funds, there the period of holding is 12 months. Anything more than that will qualify as a long-term capital gain. When I look at, say, a immovable property, there the period of holding is 24 months. And if I look at unlisted shares, again, the period of holding is 24 months. So one really needs to look at the holding period of these different kind of assets which are prescribed under the tax laws. And depending on that holding period, if you hold the property for a duration which is longer than that, that qualifies as a long-term capital gain. So in case of a, say, specifically inherited property, if it is a very old property, then the law clearly provides that if you are the holding period of the previous owner should be considered into taken into account while while determining the holding period of a property. And therefore, variably, if it was inherited was purchased by the ancestors say in 1950 or 1960 and you're selling it now, it is clearly a long-term capital asset. So that is one part. And then there are tax rates which are prescribed for each of these instruments. For example, if I look at an equity share, a listed equity share, if it is held for, as I said, more than 12 months, and if you sell it, then anything above 1 lakhs, you will have to pay a tax of 10% on that. There is no indexation available. Similarly, for any other asset, the rate is 20%. So if I sell an immovable property which has been held for more than 24 months, it will be a long-term capital as gain, and the rate will be 20%. And in case I have equity shares which are listed and which are sold where the period is less than 12 months, then you have, and where there is STT payable, then again you pay a capital gain tax at the rate of 15%. So, in nutshell, it is important to determine what is the kind of asset which I hold, what is the period of holding of such asset as prescribed under the tax laws, and then accordingly we determine the tax rate for such gain that arises. Yeah.
Divya, who exactly reports all of this in the income tax return? How do we do that?
So, in the income tax return, there's a specific section on capital gains, and the return forms do prescribe that depending on the return, whether it is ITR 2 or ITR 3, depending on where you qualify, you will have to specify the capital gains over there, and there's a separate schedule for that. And it also drills down whether it is a long term capital gain or is it a short term capital gain, what is the nature of asset which is there. So you have to fill in those details in the schedule, which forms part of the tax return. Yeah.
We move on and let's talk about financial gifts. So, what kind of financial gifts can be given, and what is the tax treatment if you're getting it from a relative or from a friend?
Yeah. So when we look at these gifts, there is nothing and no embargo under the Income Tax Act that you cannot give a financial gift or you can give a certain kind of gift or you can't give certain kind of gift. There is no embargo under the tax laws. Yes, the tax laws do provide that how will these be taxed in the hands of the donee. So if any gift is given by a person who is not a relative as defined under the tax laws, then typically anything where the value is more than 50,000 gets taxed as in the hands of the donee as income from other sources. So if anything which is given as a gift is less than 50,000, I'm talking about a case where gift is given by a non-relative. where the value is less than 50,000, then it is not taxed. But if it is beyond 50,000, then the entire amount gets taxed in the hands of the donee. And they have also defined who is a relative. And especially in case of relatives, there are exemptions, and relatives have been defined to include, say, person's spouse or linearly ascendant or linear descendant of the individual or the parents. So that is how they have defined who constitutes a relative. And if there are any gifts which are given under inheritance or under the, say, by a relative on occasion of marriage, so those are exempt. So one really needs to see whether anyone falls as the definition of relative or not, and then consequently the value of the limit of 50,000 doesn't apply if you are a relative, and that is how one needs to see.
All right. I think that will be all. Thank you so much, Divya, being on the show and helping our viewers. Everything related to the financial gifts and capital gains tax included with that.